Well, stocks searching for direction to kick off the week as investors look ahead to the release of the Fed's preferred inflation gauge later this week. But our next guest is warning of a rocky road ahead as the market looks to get ahead of rate cuts. Let's bring in Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Kathy, good to talk to you today. Taking a look at where yields are now, sort of quieted that talk about this march to 5% when it comes to the 10-year, but it sounds like you think this pullback isn't necessarily going to be a straight line down.
Yeah, I think that that's going to be the story. It has been the story, over the past 6 months or so. I think that's going to continue to be the story into 2024 because the Fed's reaction function is just different this time and probably more unpredictable this time. So on the one hand, they've tightened a lot. And they've driven real rates up. They're doing quantitative tightening. They're taking a lot of steps to really slow the economy, and inflation is coming down. In a normal cycle, you would expect the Fed to start easing sooner rather than later as inflation gets closer to 2%, as the economy shows signs of slowing down. But in this cycle, because inflation has surprised on the upside, the Fed seems more cautious. And I think trying to figure out the Fed's reaction function is going to be the source of volatility as we go into next year.
And certainly the market's jumping ahead, expecting those rate cuts in the first half of the year. But one of the contributing factors that you're looking at with this drawdown in bond yields is that slowdown in growth. And I know we've talked a lot about credit card debt, but we're also seeing that become delinquencies. And we're seeing that across all loans, according to the New York Fed, except for student loans and home equity lines of credit. What is that lag effect when it comes to the consumer? When is the rubber going to hit the road there?
Well, I think it's starting to. As you pointed out, delinquencies are rising on credit cards, auto loans, lots of trouble in the auto, especially the subprime auto area, people not able to get financing. We're starting to see some catch up among smaller businesses that are financing at very high rates right now, 8%, 10%, et cetera, and have to roll over those loans at a pretty consistent basis on a short-term basis. So we're starting to see it. But it's going to take some time. And I think one thing about the consumer we have to keep in mind is as long as people have jobs, they will continue to spend. It's just their ability to spend a certain amount at a certain pace that's probably going to slow down. And then when we start to see more job losses or certainly less hiring, that's probably when we see the consumer really pull back.
Yeah, so far the job market remaining resilient, though. Kathy, we've got the PCE data coming out later this week, the Fed's preferred inflation gauge. What's your expectation on that front, and how are we likely to see it reflected in the bond market, the reaction?
Yeah, we're expecting a slight increase this month, a month-to-month basis, but a year-over-year continue to decline, modestly. I think we get more of a kick in the next 6 months to the downside. But it really has fallen almost by half now over the past year from the peak. And we think that trend will continue. When you look at CPI, it's mostly about rent. When you look at PCE, there's a lot of different components in there. Healthcare is a bigger factor. But overall, when we start to take into account the big drop in commodity prices that's taken place so far, the slowdown that we're seeing in the service sector indices from ISM, all pointing to less and less inflation. And we're already ahead of what the Fed was estimating for the end of the year. So I think that this will give them confidence that as we move into next year, inflation is going to get a lot closer to their target than it has been over the last 6 months.
So, Kathy, for investors looking at their portfolios, what is a top opportunity that you see and what are you steering clear of?
Yeah, what we really have been suggesting for most investors is this up in quality, intermediate term duration. And by that, I mean up in quality, treasuries, other government-backed securities, investment-grade corporate bonds, high-grade municipal bonds. Those yields, if you're in a duration that's around 6 or 7, which is kind of a benchmark for the aggregate bond index, those yields are north of 6% in the corporate bond market. And we think that, a high quality portfolio with that kind of duration is not a huge risk And it is an opportunity because you're locking in pretty good yields for the next 5, 6, 7 years. And you can go off and, worry about your equity somewhere, on the other side of the portfolio will give you a lot more volatility, but locking in that cash flow with a certain amount of confidence, we think is an opportunity. Where we're staying away from is the lower credit quality, whether it's high yield or bank loans. Our concern is just that as the economy slows down, as those financing costs really sink in, we're going to see more default, and the market's just not priced for that.
Certainly a lot to take in there. Good takeaways. Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Good to talk to you today.
Thank you.